Adding a term life insurance rider to a whole life insurance policy was traditionally done to reduce the amount of premium one has to pay in order to establish a certain level of death benefit that they sought out. And still today, people do that. There's nothing wrong with it. But we can also use term life insurance riders as a way to manipulate whole life insurance policies and reduce the amount of premium we have to pay while increasing the amount of premium we want to pay. And we do that primarily as a way to maximize the amount of paid up additions we can put into a whole life insurance policy. We do this because it optimizes cash value buildup. And optimizing cash value buildup inside of a whole life insurance policy is the way to ensure we can benefit from all the great things that cash values inside a whole life policy can provide us. I want to walk through an example to illustrate why it is we do what we do when we approach life insurance building for our clients. To start, I'm going to state that for any level of death benefit that we have outstanding on a policy, there is a maximum amount of premium that can be paid into the policy that is set by U.S. tax code. So when we have a regular whole life policy, that maximum is something that we rarely ever hear about when agents present life insurance to potential buying clients. Normally, you would see the required premium, which might look something like this amount right here. On any plain old life insurance policy or whole life insurance policy. What you don't know about is this space up here, which is extra premium that you could pay into the policy. Some people do, but most people aren't even aware that this exists, this opportunity to put additional premium into their whole life policy. The mechanism that you would use to put additional premium into a whole life policy is the paid up additions rider. So a couple of things have to exist for you. One, our paid up additions rider must be available. Not all insurance companies offer them. And two, you must have an active rider on the policy. If it wasn't a rider added at issue, it's not always the case that you can add it after issue. So if this is something you've only recently become aware of while currently owning a whole life insurance policy, you may, or unfortunately you may not be able to add the paid up additions rider to your policy. If we add a term rider to the whole life policy and we keep the death benefit the same. So the death benefit on the regular policy, death benefit on this other policy with a term rider, they equal one another. So it's not as though we've changed the death benefit around. What should happen from a life insurance design standpoint is the premium that we can put into the policy stays the same. So max premium, that is unaffected. But here's what does change. The required premium amount goes down, and it can be brought down quite significantly. And conversely, the extra premium goes up. And keep in mind, because the maximum premium in both cases stays basically the same, that means if the required premium goes down, the amount of extra premium goes up quite significantly for us. This gives us substantial capacity to put discretionary or extra premium into the policy, which in turn will substantially enhance the cash value accumulation of the whole life insurance policy. Now, it's critically important to understand that not all term life riders function the same way across all insurance companies or even across all whole life insurance products. So there is a certain degree of skill that is necessary in the pursuit of building a whole life policy that is conducive for optimal cash value, at least from a rate of return point of view that's worth it as an asset you would put inside your retirement portfolio. So you can't assume that just because there is a whole life policy out there from a mutual company that happens to pay dividends and it has a term rider, it will in fact be something that you want. There are several implications and consequences of different contractual features when it comes to term life riders that may be really good and some may be really bad. So you do want to spend some time finding a very competent agent out there. We happen to be one that can help navigate this process for you and figure out what is and what may not be a good approach to building a term blended, as we like to call it, whole life policy that you put in your retirement portfolio. At the same time, I assure you that pursuing this component of whole life insurance is extremely valuable. Regular whole life insurance can build cash value, and that rate of return can be reasonably good over a long period of time. But I also assure you that if you find an agent who will do this for you, you will receive a whole life policy that accumulates cash value much more rapidly than normally would be the case for regular whole life insurance, and long term will have a rate of return far in excess of what you would normally get from regular whole life insurance. This is a key component to making whole life as a retirement asset worth it versus just kind of and probably not very worth it. So when people tell you whole life insurance may not be a great idea because the rate of return is not great, they generally aren't talking about this style of whole life insurance. It's well worth figuring out. It's well worth finding an agent skilled in the process of putting whole life policies together in this fashion. As a reminder, not everybody buys whole life insurance for the same purpose, and there's no reason to not buy regular whole life insurance if your objectives are not necessarily maximizing cash value inside of a whole life policy. If your focuses are much more permanent death benefit focused, maybe for estate planning, maybe for charitable planning, maybe for special needs trust planning, you don't necessarily need to blend a whole life policy in those situations, and you may be more well suited buying regular whole life insurance. But if your intention behind a whole life purchase is to build an asset for its cash accumulation, for some sort of self-banking purpose, or for the sake of retirement income, which is a very strong capability of whole life insurance, then you absolutely want this term blending component to be a piece of your whole life insurance design. And the key reason that this design is so critically important is because it maximizes the amount of paid up additions that can go into your whole life policy. And that in turn will maximize the cash value accumulation of your whole life policy. And if you want to know exactly why paid up additions matter so dearly, check out this video.